Markets were humming along. Investors were riding high on the boom in artificial intelligence and banking on central banks to cut interest rates. Everything looked stable. Then the baseline vanished. Following military action by America and Israel against Iran, the Middle East has been violently thrust into a massive regional conflict. The immediate logistical casualty is the Strait of Hormuz. Its closure instantly blocked 15% of the world's oil supply. Drone strikes also forced the shutdown of Qatar's main export facilities, removing a fifth of global liquefied natural gas, or LNG, from the market. By targeting the exact choke points powering global transport and manufacturing, these strikes represent a direct structural attack on the foundational inputs of the world economy. This chart shows the global benchmark for oil prices. Notice the violent vertical spike in early March as news of the blocked strait hit trading floors. If the closure is indefinite and demand must match crippled supply, prices could sail past $150 a barrel. Whatever happens in the strait, the old, cheap energy market cannot simply be restored. Energy markets have been changed forever, leaving the world in chronic energy insecurity. While the United States has built up domestic energy buffers through its own fracking boom, the shockwaves of this crisis are hitting different regions unevenly. Asia is uniquely vulnerable. This scatterplot charts liquid natural gas imports as a percentage of total gas demand. Look at the extreme upper right positions of South Korea and Japan. They rely on imported energy from the Gulf for over 80% of their consumption. With Qatar offline, Asian markets are in a frantic bidding war for whatever LNG is left. Because global energy is interconnected, Asia's panic is driving up prices everywhere else, spiking the European benchmark price by more than 75%. This energy squeeze operates like a massive imported inflation contagion, threatening to paralyze the manufacturing hubs that rely on that imported fuel. This commodity chaos feeds directly into macroeconomic policy, creating a difficult dilemma for global central banks. Policymakers are watching for a wage price spiral. This occurs when an energy shock forces businesses to raise prices, which prompts workers to demand higher wages to keep up, which in turn forces businesses to raise prices again, creating a self-sustaining inflation loop. To stop that loop, traders reversed their expectations. Instead of anticipating rate cuts, markets are betting institutions like the European Central Bank will deploy sudden rate hikes. Central banks are currently choosing between two painful outcomes: raise interest rates and deliberately trigger a recession to cool demand, or do nothing and risk a renewed inflationary spiral that destroys purchasing power. Inside the stock market, this macro panic is triggering an unexpected rotation. Financial analysts call it the dash for trash. High-quality, high-growth technology companies are losing market value. Because their massive expected future earnings are so far out in time, their stock prices are highly sensitive to rising interest rates today. Meanwhile, heavily indebted cyclical companies and legacy energy firms, often considered junk stocks by investors, are seeing a massive, disproportionate bump in value because they offer immediate cash flow during an energy-driven crisis. During a war-driven energy crisis, standard investing metrics temporarily failed to identify the winners. Just as the West suffers this explosive energy crisis, China's economic engine is experiencing a slow-motion stalling, leaving the global economy without its stabilizer. This line chart shows the age distribution of China's high-net-worth individuals. An enormous intergenerational wealth transfer is underway, concentrating capital in the older brackets and transforming the society into an entrenched aristocracy that stifles upward mobility for the youth. Youth unemployment has surpassed 16%. In response, millions of young adults are embracing a movement called lying flat, choosing to withdraw from the economic rat race entirely. With internal wealth hoarding and youth pessimism rising in the East, China cannot be expected to bail out global growth during the West's inflation shock. Businesses must now permanently price a geopolitical risk premium into their supply chains and inventory management. The threat of regional conflagration has become a constant in strategic planning. The global economy is unmoored from its previous stability, leaving portfolios exposed to a world that is inherently more volatile and harder to govern. The period of easy global growth is finished.